Seller financing is a creative real estate deal where the person selling the home acts as the bank for the buyer. In a standard deal, you get a loan from a bank. With seller financing, you bypass the institutional lender entirely. Since no bank is involved, the buyer and seller negotiate the loan terms directly, which can sometimes speed up the closing process. The buyer gives the seller a down payment and agrees to make regular mortgage payments directly to them until the debt is cleared. Traditional bank loans have rigid rules, while seller financing offers flexibility that can help buyers who do not fit standard banking profiles. Seller notes are often short-term, meaning they might require a balloon payment after just a few years, unlike a 30-year bank mortgage. Because these deals lack institutional guardrails, having a lawyer review all documents is essential to protect both the buyer and the seller. Seller financing can be a powerful tool, but it carries unique risks. Please do your research and subscribe for more finance basics.